So these spousal household income tables can still be utilized for the purposes of making contributions into into the IRA. So let's say one spouse does not make much or anything, but the household income on the joint tax return tables are showing $100,000 of earned income. Well, that couple can certainly make a full contribution for the taxable year of 2019 and 2020, assuming that the income proceeds into the following year. Now, the nice thing about this is that you have up until your filing date, so April 15th or whichever date that the filing date falls on, in order to make a previous year contribution. So if you have not made your traditional or Roth contributions, whether that be if they're household or individual, you still have up until April to make the previous year contributions. Now, determining the deductibility of these contributions is very important, and your eligibility to make those is also important because although the mechanisms do exist for anyone to make a Roth IRA contribution, or essentially, well, I should correct myself, in order to get money into a Roth in a contribution fashion, you can't always make the contribution directly. So when you're talking about making deductions for this, the traditional IRA is a deductible contribution plan, and the Roth IRA is a non-deductible contribution plan. Another way to phrase this is that one is pre-tax, being the traditional, and one is post-tax, being the Roth. Now, the advantages and disadvantages of those can be argued in many different scenarios, but suffice it to say for this, you need to kind of determine whether or not you really need deductions or if you can stomach having to pay a slightly higher effective tax rate by contributing to the Roth, or if you're okay with just putting money into the traditional. Now, the ability to deduct traditional contributions is finite. You do have a phase out of being able to deduct those contributions. Now, if you are phased out of making those deductible contributions, although you can still make them, it might very well be beneficial to you to look at contributing to a Roth IRA. So if you are a high wage earner, and in general, if you're earning over a household income of about $200,000 per year, you're going to be phased out of the deductibility of traditional IRA contributions. So they would still be non-deductible contributions made to a traditional, making those contributions to traditional, and then converting them into a Roth, considering that you potentially have the ability to create non-deductible basis in a traditional IRA. Now, you do need to get with a tax planner or a tax advisor in order to properly determine if you are a higher wage earning family or individual, the merits of converting a traditional to a Roth, because that is a potentially taxable event. And in order to avoid double taxation, it is something you need to do correctly. If you'd like to do some individual research on that, the filing that you need to do for that is what's called IRS Form 8606. So if you would like to do a little bit of research before contacting a tax professional, that would be kind of where to start Googling, if you will, to get some more information on that. Now, the same phase outs for deductibility on traditional IRA contributions are a little bit scaled down, but you also have the phase out of being able to directly contribute to a Roth IRA. So for those same individuals, if you're making non-deductible contributions, you also cannot make a direct Roth contribution, but you can always do a conversion. The Tax Reconciliation Acts of 2005 removed any limits on the amount of earnings that an individual can have and still do a Roth conversion. So you can make there is no limit on the amount of earnings you can show in a given year in order to be able to convert any amount that you would like to into a Roth IRA. Granted that if you do perform a conversion, it will be counted in the taxable year in which you did it. So unfortunately, if you would like to have done a Roth conversion and had it count for the taxable year of 2019, that window has passed. But if you do want to do a Roth conversion still, it's going to count on your taxable year of 2020 or inherently in whichever taxable year that you perform the conversion. Now, unlike some other accounts, Traditional and Roth IRAs can be established for the purpose of making previous year contributions all the way up until your filing deadline. So on April 14th, if you still want to make a 2019 contribution and either get some Roth or traditional monies into one of those accounts, then you can establish that account up until the filing deadline to make the contribution and still be counted in the 2019 taxable year. Some things to do with 401ks and simple IRAs have some different establishment deadlines, but the good news is for those filers, especially if you are thinking that, hey, I did not make a contribution in 2019, but I still would like to get some deductions, or I still want to get my retirement planning started, but did not do it until this time, you still have plenty of time left in order to get those accounts open and make those contributions. Now, some other things to look at is that if you are an older individual, namely individuals over the age of 70 and one half, you're going to have some restrictions on your ability to contribute to a traditional IRA. Now, there is some current legislation that will more than likely eliminate that ability to not make contributions so long as you have earned income past the age of 70 and one half. But it's important to note that if you'd like to make a deductible contribution and you're an individual that is of or above 70 and one half, you cannot contribute, meaning take money out of your earned income. So even if you're, even if you're still working as an individual of that age, you cannot directly take money out of your earned income and put it into an IRA, or a traditional IRA, I should say. The exception for that is that if you have a Roth IRA and still have earned income, you can still make a contribution to that up until the event of your death. You can still make the contributions to that. And unfortunately, there's no ability if a individual has passed away for their estate to make a contributions to the retirement plans. They have to be made within the individual's defined lifespan as well. I think that pretty much covers it for traditional and Roth IRAs. Again, just to recap, making sure that if you want to do it, that you have to have it open and contributed for a previous year up until the filing deadline, timely filing deadline. That's it. That's important to remember. Even if you file for an extension as an individual, you have to do your IRA previous year contributions by the timely filing deadline, even though you may not have to file your taxes until into September or October, depending on the type of extension that you have. You still will need to make sure that those accounts are open and funded for the previous year by the timely filing deadline for individuals in the United States. Okay. SEP IRAs. Now, not much has changed with regard to SEP IRAs, with regard to how much money an individual can defer of their compensation into one of these plans. So previously, it was up to $55,500 for 19, and again for 2019 or for 2020, it's $55,500 is the max contribution limit as well. The way that you factor these types of contributions in a simplified employer pension component of a traditional IRA is that you take 25% of the first $270,000 that the employee's compensation, and then you can factor in the maximal amount of contribution, which cannot exceed 55,000 $55,000 for a given year. The slides, they are emailed out after the presentation. This also will be on YouTube as well, Jack. If you have any questions, you can always refer back to the presentation at a later date. Okay, so with regard to SEP IRAs, so the contribution limits inherently have not changed. Now, the way a SEP IRA works is that if you have a business, and these typically work well for people who make higher wages that are paid on like a 1099 basis, that are paid as contractors, or that have a lot of earned income, because it helps you reduce the amount of shown income to yourself individually, especially if you're a sole proprietor or maybe operate as a single member or an S corp, something to that effect, because it lets you reduce the amount of income that you show and also create a corporate deduction. Then if you're passing a corporate deduction of the amount of deferral into that plan. Now, if you're filing as an S corp or a sole proprietor, there are potentials for you to pass on that deduction to yourself personally and also reduce the amount of income that you're showing for purposes of calculating your modified adjusted gross for the given taxable year in which you're trying to make the deferral. Now, while that may sound a bit cumbersome, essentially look at it like this. You can contribute up to 25% of your compensation for a given year, not to exceed $55,000 into that plan. Now, that will be a reduction. So that is a corporate deduction that is made. And then you're also going to be showing less income for the purposes of taxation when you actually go and calculate your taxable liability out of your pay for that year as well. Now, one thing, especially with self-employed individuals, you calculate the contribution less 1/2 the self-employment taxable rate. So with individuals that are operating a small business, you don't have to factor in your contribution less that 1/2% self-employment tax. So if you do qualify for having to pay the self-employment tax, you need to understand that your calculation for a SEP IRA is going to be a bit augmented past someone that's maybe operating a business that has several employees, or that can essentially anyone that doesn't have to pay that tax. Now, a nice part about this, unlike with some plans like defined benefit plans and simple IRAs, you're not locked into making this contribution every year. So especially pertinent to the individuals that are either very small business owners or self-employed individuals, earnings and profits can vary very widely from year to year. And if you're required to make, let's say, a 3% non-elective profit sharing contribution into the plan, that can greatly reduce your ability to expand a business if you have less cash flows because you're required to contribute to a plan. Now, with this plan, although you can contribute up to 25% of your base income to the plan, you're not required to do so on a year-to-year basis. So if one year you wanted to max out the plan or contribute as much as possible into that plan, and then the next year you had significantly lower earnings, or maybe needed to do some capital improvements or buy some equipment, or maybe your tax planning strategy changed and you needed to create less cash flows or spend some money to reduce the amount of taxable revenues of the business, you can do that and then change the amount of contribution that you're making to this plan on a year-over-year basis. Now, with SEP IRAs, you do get the added benefit since it is a employer plan. Now remember, a SEP IRA is a simplified employer pension component of a traditional IRA. So it has to be attached to some type of business activity. So the contributions for that can be made up until your filing deadline. So if you file corporately by the timely deadline, that's in April, or if you file by the extended corporate filing deadline, you potentially have until October to make the contribution for a SEP IRA. But keep in mind that a SEP IRA is a component of a traditional IRA. So that $55,500 mark that I said is the amount of deferral you can make of your income does also include being able to make a $6,000 or $7,000 traditional IRA contribution. So you can tack that on. So the traditional IRA contribution can be tacked into the $55,000 that you're already contributing. However, that smaller component has to be made by the April filing deadline. The salary deferral portion of the SEP IRA can be made up until the extended filing deadline. So there's a couple different things to look at in there, because the best way to describe a SEP IRA is more or less a traditional IRA on steroids. You have a traditional IRA with a SEP component. The SEP component is the salary deferral portion, and the traditional IRA is your $6,000 or $7,000 base contribution of earned income that you can make on any given year. And another nice thing is that just like with the traditional and the Roth IRAs, you can establish this plan in this given year to make a previous year contribution. Now, To kind of go back a little bit, we had talked about being able to do Roth conversions. Now, granted that they are only going to be counted in the given taxable year in which they occur. So if you do a conversion, it has to be done from January 1 to December 31 to be counted in that calendar year for basis of taxation. Now, there is no such thing as a Roth SEP IRA, although we'll get into a moment the fact that there is a Roth component of a 401k if you're interested in utilizing that. Remember, Roth is after tax contributions or monies that have already been taxed that are now inherently going to grow tax exempt, and the distributions of any earnings will be tax free as well in the future. Now, a SEP IRA, this is all deductible contributions, so it's all pre-tax, so it grows tax deferred, meaning that you are going to pay taxes when you distribute money out of one of these plans. However, a Roth conversion can be performed on a portion or all of your SEP IRA contributions. So if you would like to be able to put upwards of $60,000 into a Roth, and you would like to, and you're okay with paying um, the taxes on all of those funds, you can contribute to a SEP IRA and then immediately convert it to a Roth IRA, thereby creating a completely tax-free growth IRA. Now, again, that is definitely something to consult with a tax advisor on. That can be a significantly high amount of taxes that you're paying, considering the income you're claiming has had no withholding taken out of it. So the full brunt of the taxable event will be borne by the actual taxpayer that is performing a SEP IRA conversion. But again, they don't have to be done all at once. You can do them at small intervals, but they do have to be done within the taxable year in which you are trying to have that done. So again, if you'd like to make a previous year Roth conversion, unfortunately, there is no mechanism for doing that. And just to also elaborate, the ability to unwind a Roth conversion has been lost. That was with the tax changes implemented in the end of 2018. So 2018 was the last year in which you could do a recharacterization of a Roth conversion. So once you do a Roth conversion now, it is pretty much set in stone. There is no mechanism to unwind it. So it's very important to understand that if you want to do that, and with it being potentially a very um, high amount of taxation that you're going to be responsible for, it's just good to know that it's something that is cannot be unwound. And also with the SEP IRA, you don't necessarily have to have it established by the filing deadline timely. Just keep in mind that your traditional IRA contribution that you're eligible for needs to be made somewhere. And then if you are going to make the SEP contribution, you can establish that by your extended filing deadline, but the traditional portion at least has to be made much earlier in the year in April. Actually, we're going to do simple IRAs first and then go back because the 401k is something I would like to end on. So the simple IRA, although a bit antiquated, still has its place, and it's important to understand, especially if any of you out there listening right now have simple IRAs. We don't certainly want to leave you without any information on these. So a simple IRA is the predecessor to the SEP IRA. The SEP IRA was a much more simplified, and in the name, a simplified employer pension plan. The simple IRA, and personally, I find it a very misleading name for a rather complicated plan. It's the Savings Incentive Match Plan for Employees IRA, SIMPLE IRA. Now, this is one that, although has its benefits, especially for those that maybe have high degrees of transient employees, so people that don't necessarily want to participate in the plan, people, a good example is I have some clients that operate a beach rental service for things like paddleboards and kayaks, that would allow them to have a plan and not necessarily have to go through as much regulatory requirement because they don't necessarily need to offer it to, people that, only work a certain amount of hours for them a year that aren't full-time employees that maybe only work part-time. It makes it a lot easier to administer a plan when you have employees such as that. So with regard to simple IRAs, your elective deferral limit is going to be $13,500 per year per employee. So that means that if you're a self-employed individual, you can defer $13,500 of your income. So what you're paying yourself, so as a payroll deduction, you can contribute $13,500. If you're over the age of 50, you can contribute an additional $3,000. So you can defer up to $16,500 per year of your income into the plan if you are over the age of 50 and a half. Now, keep in mind, this is what you're going to be taking all of your deductions out of, so Social Security, Medicare, um, federal withholding, earned income. So what you're paying yourself is what the elective deferral is coming out of. So 13.5 under 50, 16.5 for over 50. Company contributions can be one of two things. They can either be 2% non-elective of each employee's compensation. So if you made $100,000, you can contribute in an additional $2,000 just across the board. Or you can say 3% matching of each employee's should be contribution. So you can either do compensation, non-elective, or you can do a up to 3% matching of the employee's contribution. Now, the bad thing about this, maybe bad's not the preferred way to describe this, but that cannot be changed for 2 whole calendar years. So let's say you are a small business and you have to, in that case, buy, additional paddle boards or kayaks for the business that you were, one of my clients runs. You then in turn would have to continue to make that contribution at the same rate, and keep doing that, even if you needed more capital held in the business, or you would face very steep penalties for not doing so. So there are very big restrictions placed on the flexibility of the simple IRA that are not placed on either a traditional IRA, a SEP IRA, or a 401k for individuals to keep in mind if you do establish one of these plans. An employee cannot be covered by more than one simple plan. So if you have a simple plan at, let's say, your day job, and you also want to open up a real estate business and you want to establish a simple plan, unfortunately, you can only be covered by one of these at a time. So these types of plans do need to be established before the end of the applicable year in which you would like to make deferral contributions. So if you want to make 2019 contributions to a simple plan, unfortunately, as with the SEP IRA, you can do that well into the next year. This one you had to have established in the previous year in order to do that. Now, let's say the simple plan that you've participated in maybe just isn't for you, or it's with another employer. You cannot roll out of that plan for 2 years from the beginning of your participation in that plan. So you're locked into it. Unfortunately, there is no getting around that. That is a hard, fast restriction. There are no kind of hardship exemptions for that. That plan cannot be rolled out for 2 years after the initial participation in it. And you must include all employees who make over $5,000 per year. So that's something to consider with regard, especially if you have a more transient employment base. If you just hire people part-time, that may not, these are people that certainly are not as eager to participate in a retirement plan because typically they're lower wage earners, and they also need, in most cases, more of the money that they are being paid. So the ability to exclude some people is there. I always feel kind of bad saying that, but it does have its place when trying to do retirement planning to make sure that the individuals that are going to get the most benefit of being covered and are the most eager or willing to participate are available, and the ability of individuals who may not want to participate for them to be excluded and not forced into a retirement plan that they do not want to participate in. And just keep in mind that if you are interested in the simple, it's not something that I would recommend that you do, for lack of a better word, alone. Make sure that you get some good tax advice. Consult a tax advisor, or at very least your accountant, before getting into one of these things, because it's not something that you can, run for a year or 6 months and then wind down. You have to keep it up for 2 years. You have to make those contributions, and you cannot change them for that entirety of the 2 years. So it can be really a big burden to your business to establish one of these kind of things and not fully understand the gravity of the things that you were electing to do with it. All right. Now, my personal favorite, the individual 401k. I think these things are very cool plans. They have a lot of really great features that can really help small business owners. But again, there are going to be restrictions on this, and there are going to be places where maybe this is not the best plan for you. It can certainly vary from individual to individual, and especially if you have any common law employees, it is going to be something that can be very expensive to administer once you get to, having a couple of employees that are not equitable owners of the business. We'll get into that in a minute. So the amount of funds that you can add into a individual 401k or for any 401k on a given year is as follows. You can contribute up to $19,500 for the taxable year of 2019 and 2020 for the purposes of your deferred compensation. So your elective deferral, what you tell your employer or what you take out of your own personal pay, again, that is what is going to have all of your ordinary income taxes associated with it. So Social Security, federal withholding, state withholding, you can defer up to $19,500 of that income per year. And if you are over the age of 50 and a half, you get an additional bump. And this one's actually pretty significant. This one is a $6,000 bump instead of like $1,000 with a traditional or Roth IRA, or 3,000 with a simple and none with a SEP IRA. You get a full $6,000 bump in the amount of elected deferral compensation that you can kick into these plans on a given year after the age of 50 and a half. So bringing your contribution total up for your elected deferral to $25,500 per participant. Now, a lot of people call these plans a lot of different things. Some people call them, oh, my profit sharing, or oh, my employer match. There's a few different ways to look at exactly how you factor in your contributions to an individual 401k or 401k in general. Now, from a very high level, when you work for a large corporation, they say, hey, we are going to match every contribution that you make up to 4% of your salary, dollar for dollar. Okay, great. Well, what that really is that they are taking advantage of the corporate deduction on the offering of this plan. Now, for individuals that are self-employed or own a small business, and you really want to get aggressive with contributing, what the maximal amounts that you can actually contribute on the profit sharing side is going to be up to $35,000 per year per participant. But here's how you factor that. So when you look at the total revenues of the business and you look at the net operating income, so your after expense before taxation income, the business can contribute up to $35,000 per participant, but it cannot be more than 20% of the net operating income of the business. So you take 20% of the NOI of the business, and then you divide that number by the number of participants in the plan. So if it's just you as the individual 401k owner, it is whatever that number is, up to $35,000. So you take the 19,000 of elective deferral, add it to the profit sharing, and then that's what you can contribute on any given year to a 401k plan. Now, the 401k has an additional benefit, unlike the SEP IRA where you have to do a Roth conversion. The 401k has the ability for the participant to elect to either take a deduction or not take a deduction. So again, after tax, pre-tax or post-tax, meaning traditional or Roth, of their elective deferral. So that $19,500, the $25,500 can be made either as a traditional 401k contribution or a Roth 401k contribution. Now, keep in mind that the profit sharing portion of the contribution to a 401k plan is always going to be made pre-tax on the business side. So the business is creating a deduction. However, the participant, and so long as that the plan allows for it, can then in turn convert that and claim that 35,000 as additional income. So depending on your tax planning strategies and also how you have your business set up is going to determine where that profit sharing match deduction is going to land. Individuals that are operating an S corp or a sole proprietorship can in some cases pass that on to themselves personally, thereby, if you're not doing any after-tax contributions, creating somewhere around the neighborhood of $60,000 or a little bit more of deductions for them and salary deferrals and profit sharing contributions. Or if you're okay with paying a slightly, higher marginal tax rate, or if you have losses or anything else that would help you offset some of these things, you can do things after tax and also do Roth conversions. Now, a solo 401k cannot cover businesses with rank and file employees, meaning anyone that qualifies as a common law employee, more reduced down, essentially anyone that works over 1,000 hours per year for you has to be offered to participate in a 401k plan. So the individual 401k is specifically set up to where it doesn't need to have the testing requirements done, because you can only have this if it's an owner operated business or the owner of the business and their spouse. So you could have several employees, quote, that are all equitable owners of the business in any amount that can be covered by a solo 401k plan. But the second that you hire, let's say, an administrative assistant, and they work 8 hours a day for you, 5 days a week, then you're going to need to change the type of 401k plan that you have from an individual to a one that's set up for a small business. That is just going to include a little bit of additional cost. You have to have a different type of plan document that agrees on the availability of the plan and establishes some other vesting schedules. But although that may be a downside, the additional benefit to the 401k is that the amount that you contribute can be changed from year to year, just like with the SEP IRA. Really, the only one that has the caveat of a restriction on that is going to be the simple IRA. So if you are going to have changing revenues or things are going to change with your business, it's important to understand that a solo 401k does allow you the flexibility in order to be able to make changes to the amount of your contributions. Now, nothing has changed with regard to the timetables for when you have to make these contributions. You need to do your 19.5 or your 25.5 elective deferral contributions by the end of this month for the plan, so long as it was established last year. And I guess that brings up another good point. These plans must be established within the defined calendar year in order to make a contribution for that year and the following year. So an example, an individual has a solo 401k established within the parameters of 2019. You need to have your elective deferral made by the end of this month, and then your profit sharing match, you can make that contribution up until your filing deadline or your filing deadline plus extensions. So this one does have the ability to make a part of the contribution up until up until your extended corporate filing deadline for the individual 401k. And I believe that about takes care of it. Just to kind of add on a few things, there have been some legislative changes that have been pushed through, which, assuming that they go into effect, will probably remove the ability or the disability of, or sorry, the inability of an individual to make a contribution to a traditional IRA past the age of 70 and one half, to also extend the tax saver credit to low income earners for making contributions to traditional and Roth IRAs, as well as coming up here. What is the other big one? Oh, one that I think is really good, allowing individuals to take out a defined amount of funds without a prepayment, without a early distribution penalty, for the purposes of covering adoption fees for married or individual people, and then allowing them to roll those funds back into an IRA after they have performed the adoption. Okay, well, Chris has a question. Can you review the deadline requirements for removing a overage of Roth IRA contributions if you do not qualify for a contribution in that following year? In that filing year, does the traditional IRA have the same deadlines? So it's going to kind of, there's a few different options you have with that. You can either, and the coding is relatively self-explanatory, so I'll go through it real quick. So you can either distribute current year excess contribution, which essentially is a fix of a contribution that was made in a given year, and that's saying that the custodian is not reporting any type of taxable event to you. It's still reported on 1099, but it's a current year removal of excess contribution. Now that can either be traditional or Roth. Now in the following year, if you were ineligible to make the contribution in the previous year, you have a few different options. If you are going to be eligible in the following year, you can have it redesignated to the following year. So you can have a distribution code that is going to redesignate that previous year contribution to the current year. Or if you do not believe you are going to be able to make it in either year, you can distribute it. You might have to pay a penalty for the overage, but you would not have to essentially pay taxes on any of that distribution if it is a distribution of previous year contribution. Now, the deadline for doing those kind of things is your timely filing deadline of April 15th or December 31st, depending on which applicable code you are trying to have that distribution done as. Can an individual business owner, such as a Schedule C or S Corp, have a SEP IRA or solo 401k and an IRA in the same year? So potentially yes, but the SEP IRA and the solo 401k are going to kind of be antithetical to each other in a sense because your deferral of compensation is going to directly affect your elective deferrals are going to directly negate each other. You're going to have a total spread that you can contribute between the two. And honestly, I'm not sure if that's going to affect your ability to make profit sharing. I think you're still going to be able to do that in the 401k. So I know you can be covered by multiple 401ks and participate in profit sharing for each, but you just can't do your elective deferral to each, which is the 19.5 or the 25.5. So potentially, you can always be covered by an IRA with irregard to what type of business that you run. So that's fine. Ed asks, over 70 and a half, can you do over 70 and a half if you are self-employed? If it is a Roth IRA, yes, you can continue to contribute to a Roth IRA presently with the current tax law, if it's a Roth IRA and you want to contribute. With a traditional IRA presently, no. However, legislation that is just passed through Congress would aim to remove that. It doesn't look like that there's going to be any challenge to that. I don't believe Trump has signed that yet, but I don't keep as much of a watchful eye on some of those bills as I should of when they actually get signed. I pay attention a lot when they're being debated in Congress and the House. So, but that is most likely going to go away because I don't believe there's any. I believe it was a mainly Republican bill that being championed. Oh, he did actually sign it. Oh, okay, great. So John just confirmed. I'll double check that, but yes. So then it has been removed. So then I would assume for the taxable year of 2020, then that would go into effect. But I need to double check before I put that out. I'm sure we'll put out some blog or some press release information regarding the Secure Act once we kind of go through it with a fine tooth comb. So that's pretty much it. With regard to what we have, now continue to answer questions as long as they come in. Let's see, Chris asked, if you do a distribution from a Roth IRA by the filing deadline to avoid penalties, are you aware if you are required to take out any profits on investments of that contribution? So that depends. So if you have net earnings attributable to that contribution, you can either leave them in and pay a pro rata penalty, or you can distribute them out of that. And I'm not sure if there's a. Oh wait, no, I got to really remember back to to my last time I had to do a test on this. So distribution from a Roth IRA by the filing deadline to avoid penalties. Um, yes, you are required. Okay, I remember recalling it now. Yes, you are required to take out any net earnings attributable to that contribution amount. Now, the issue that it brings up, though, is that if you had a Roth IRA for several years and your contribution was made into that plan, and then you had total earnings of the account, how do you define what the net earnings attributable are to that specific amount of contribution unless it had its own specific investment that it was doing? So that's where it can get kind of hectic. And I recall a case I had to do for a client where there were net earnings attributable to a larger portion of a Roth IRA. So it comes down to a lot of kind of pro rata calculations of exactly what that would be attributable to. But yes, you do need to distribute any earnings attributable to that over Roth contribution if you cannot carry it forward or distribute it within the defined year. All right. Well, if we don't have particularly any other questions, we'll let you get out of here a few minutes early. If anyone has any questions, let me just advance the slide to the end. Feel free to contact me directly. I am more than happy to answer any specific questions that I can in my capacity here at Advanta. My number here is 727-754-9954 or A Perny, Perny at advantaira.com. I want to wish everyone a happy and prosperous new year, and I hope you got some good information out of this. Again, not a whole lot's changed, but a couple changes coming through the pipeline for contribution ability of older individuals and some other good things. So if you have any questions, feel free to give us a shout. Again, 727-754-9954. Thanks for joining.